Hello and welcome to the Invest with Carl podcast. I'm Jamie Uppenberg and a member of the Carl team. We're chatting today with George Egan and Masao Matsuda from our new fund, Fuji. It's another Fuji, but we have rebranded the old Fuji, so you'll see something different on the app. We'll ask the usual first questions about the fund. We'll find out what makes it successful, some of the history, and of course, what's important for you to know if you are interested in investing. We are Carl, digitally offering unique investment opportunities with packaged and data-driven delivery to accredited investors. Fuji is an upcoming investment opportunity on the Carl app. Today, we're chatting with George, who has been in the financial industry for over 45 years. He has run trading desks at various banks. He ran a hedge fund at Morgan Stanley and has been an asset allocator for both public and private entities. So George has been doing this a while, probably longer than several of us. He saw Masao speak at a professional speaking engagement and convinced him that forming a hedge fund around his strategy was a great idea. It could be the best use of his strategy. Also, we have, of course, Masao Matsuda with over 30 years experience in financial services, mostly in investment management, and he has a PhD in political economy. He was also chief investment officer of asset allocation funds for Nikko Asset Management out of Japan. And he built a quantitative asset allocation model, has done all kinds of research that relates to asset allocation. So as today goes, I believe Masao is our asset allocation expert. Welcome, gentlemen. Very nice to be chatting with you today.
Great to be here with you, Jamie.
As we kick off, and what I've heard is you guys have a kind of a whole new class of investments. So, in the normally I'm talking about equities. I'm talking with folks who play in the commodities markets, and every now and then we get something a little more interesting in that space. In this case, you guys have something I've never heard of before, and I hear not too many people have. So do you want to kind of explain what we're investing in with Fuji here?
Well, let me address this. So these days, some sophisticated institutional investors, like sovereign wealth funds, like Singapore's GIC, and also Canada's CPP and so on, they started talk about something called total portfolio approach, and which is a big departure from the traditional method of allocation, which is based on strategic asset allocation. And so under this TPA, total portfolio approach, they really focus the risk that leads to that affect performance irrespective of traditional classification of asset classes. And in the end, they ended up investing through risk factors. And, for our implementation, we call it investment strategies. So this has been happening in the past year or so. However, for 5 years or so, I have been talking about something called alternative asset allocation. And this exactly addresses the same issue. Departure or move away from traditional strategic asset allocation and focus on risk premium factors.
So risk premium factors, what are those? What are we actually putting money in?
Some people call it smart betas, but that's only a part of it. So basically, any asset class of the returns can be decomposed into exposure to several risk factors. So by isolating those risk factors, you can have a better allocation without much noise.
If I'm hearing you right, if you isolate the risk factors
within asset classes, sometimes it's go across asset classes, risk factors.
You isolate the risk factors among the asset classes. You can then invest. I don't know, is it against the risk factors? Like you can invest that they're going to move in a particular way?
Yes, the risk factors, the asset class itself has many noise other than the exposure to risk factors. So we want to avoid having exposure to that type of noise. Also, we can combine risk factors that are negatively correlated to each other or have very low correlation among each other.
Right. So we'll talk about removing some of the risk from the portfolio and allowing diversification.
Goal of asset allocation is to realize a diversification benefit,
Right,
right?
which is a huge benefit. And what most hedge funds are trying to do is diversify within themselves.
Right.
Can you give me an example within, your algorithm looks at volatility within the equity market that your premiums are going to mirror, as it were? What do you actually end up investing in? Like, where do you place the investment, and what are you saying is going to happen?
Investment banks offer a series of quantitative investment strategies to mostly institutional investors. So those are the strategies that consist my investment universe.
So if they generally only offer them to institutional investors, how are you guys just were able to you're
Yes.
able to invest in them?
Yes.
Okay. So we're kind of getting into a whole nother echelon of investment that most people don't ever get to participate in, even if you're, a bigger accredited investor. This is
Right.
a brave
Right,
new
in a way,
world.
yeah.
I
Yeah.
think it's the level of sophistication of these investment indices that makes them institutional more than access. Would you say that's fair, Masao?
I think so, yeah.
Yeah. So Masao's been in this space for 4 or 5 years, and now the most sophisticated institutions are moving in that direction recently. So you can see we're at the forefront of something new here, and it's going to be unfamiliar to just about everybody.
Yeah, it sounds like you're getting us access into something most of us, including myself, I've never really heard of before.
I saw Masao speak last summer, and it was new to me completely, and it took me quite a while to get my arms around it.
Okay, so I don't have to feel badly if it was
No,
new to you and you've been doing this for 45 years.
Yes, right, and it's a whole new world to me. But it's
Okay.
good to hear that, these big institutions have only been doing it for a year. So it's new to them too.
Right. And Masao's been looking at it a bit longer than them, it sounds like.
Right.
Like he kind of caught it a little early.
Right.
Mhm.
So
Yep.
yeah, it's like a new asset class, which goes great in a portfolio because it has no correlation to the others.
To anything else. Yeah. What makes the Fuji strategy successful, or what makes you think it's going to be successful? Why would you keep it in your own portfolio, aside from the fact that you manage it?
This is a really great instrument. Masao has done really interesting work in asset allocation, unlike anything I had been familiar with in my long career. I think it is unique in a portfolio, and it's unique in its potential and risk profile. Masao has done decades of research on asset allocation, and I'll let him speak about it.
So, throughout my career, I really focused on asset allocation, either as a researcher or actually implementing it. And in the process, I really learned the importance of focusing on the volatility or risk of equity market. And equity volatility actually affects the returns and the correlation of other asset classes or among other asset classes. So it's really important to focus on that. Our strategy for Fuji is called Dynamic Factor Portfolio. It uniquely uses this knowledge to take advantage of the opportunities that understanding of the equity market risk present. Also, we seek diversification benefits in two ways. The DFP is implemented only when its risk-reward ratio is expected to be high, and investment strategies within the DFP have low to negative correlation to each other and to the market.
So what is different in the asset allocation? Like, what is different in how you're choosing what to invest in than other investments on Carl or other hedge funds that you've seen?
Okay. Yeah, let me give you more specifics. So the first step is for me is to forecast next month's equity volatility. And most asset classes tend not to do very well. And most investment strategies tend to do not to do well either. But there are some strategies that do well under equities high volatility. So those are the strategies I focus on. So first, I predict equity volatility. And when I expect high equity volatility, I combine a certain number of strategies with certain weight.
And when you say you predict the equity volatility, like what does that? How is your prediction better than something else we might see?
Equity volatility actually tend to persist, but there are some statistical techniques to improve the accuracy of your prediction. My prediction is a little over 70% right. So when I expect high volatility, after the fact is turned out to be high volatility month.
We pick from a large list of quantitative investment indices that are offered to institutional investors only through investment banks. And what Masao does is select among those to build a portfolio that firstly hits the risk profile we're looking at, which is to keep any mistakes or losses under 10% in a month, to keep them infrequent. And secondly, to construct a portfolio so that it maximizes returns within those constraints.
So what I'm hearing is that Masao, you basically created a predictive algorithm that helps you at a very reasonable confidence rate determine what next month is going to look like. And then given if you know what the volatility is going to look like, and given the indices that you're feeding into the algorithm looking at, you can get a selection of investments that match the risk reward profile you're looking for. And it sounds like that's been successful at a confidence rate that you're enjoying. Is that the case?
Yes. Also, another helpful thing is that the correlations among these investment strategies tend to be either low or negative. So that helps with managing risk.
Right. And that's actually part of what we go into in the next question is you talked about that, you don't want to have losses over 10%, and that's fed into the algorithm's selection criteria.
Mm-hmm.
Is there anything besides that the algorithm knows we don't want to have losses over that? What other aspects of your process help reduce risk and give investors confidence that they're not going to have significant or material losses beyond what they're
in choosing investment strategies? I actually first look at tail risk of each strategy. So say there are 60 candidate strategies, okay? And many strategies with great returns tend to have high tail risk. So sometimes, for given months, you may have, say, 12% loss. Now, I systematically eliminate any strategies with that type of tail risk. And tail risk, this becomes a little bit more technical, but also appears in statistical numbers called skewness or kurtosis. So anything that's tend to be associated with tail risk, I eliminate them. So the number of candidate strategies get reduced to about 30 or less. And out of that, I try to come up with the great combination with low to negative correlation to each other.
So that you have the diversification so that if there is a negative outcome, it's not across all the investments you're making.
Yes. Yeah. And that diversification in effect has the same effect as doing asset allocation, actually.
Right. Which is what most people want to see in a hedge fund, that it diversifies within itself, so that even if you're holding one hedge fund, it's almost like holding a diversified portfolio. So you're doing what most investors are looking for if they are looking to go into hedge funds.
Mm-hmm.
Help me understand, like you are, however, betting on the upward movements of the equities. We're not hedging against the market, or are we doing that as well within?
I don't feel I'm betting on anything. Okay. Let me just give you a very simple fact. say this is a simple empirical analysis, just looking at past numbers, okay? When you look at monthly return of the US equity market since 1949 for 7-year period, okay? And if you divide that 7-year period into two groups, one with, on average high volatility, the other with lower volatility. So those high volatility months had only roughly 0.2% of returns on average. And those months with low volatility had roughly 1.8% of returns. And that's 9 times as high as 0.2%. So it's important to focus on those months when we expect our algorithm predict high volatility. You probably want to do something. And our dynamic factor portfolio actually helps with the situation and reduce risk and add returns.
Jamie, I wanted to add that many of these indices are not related to the equity market, but their performance has correlation to equity volatility.
I see.
And that's how Masao selects the portfolio and helps design it. So these are pretty arcane indices, unusual.
Unusual. Okay, so something our investors may not be familiar with at all.
They may not be familiar with them, but I would, suggest, and maybe Masao will correct me, but hypothetically, you could look at something like the spread between the 2-year and the 4-year, treasuries. It's obviously not an equity, but it's something that moves, and equity volatility has an impact on it. I don't know if, in fact, that is one of the indices, but it helps me think about it.
It's the type of information he may be looking at.
Right.
It's not necessarily treasuries, but yes, that will be rate-related strategy.
Right.
Okay. And then, so what are you actually invested in after you do all of this? What are you actually invested in?
It is called risk premium or risk factors. But in reality, many investment banks offer investment strategies that match the performance of these risk premium or risk premium factors.
So if our investors are holding a portfolio that's invested in the equity market, and maybe they even have a little in the commodities, what would they consider then your hedge fund within their portfolio? Just something completely different? How would they consider it amongst their own diversification?
This strategy would be substantially helping those investors when the equity markets perform poorly. And those are the times also most hedge funds perform poorly.
I think, yes, Jamie, you would think of it as something completely different, a different asset class.
It sounds like it's sort of you're making investments against risk factors that Masao's algorithms seem to have a pretty high confidence level that they're going to accurately predict the movement of.
Right. They're called risk premium, but I believe it's kind of a misnomer and misleading.
Mm-hmm.
They're quantitative indices, and they're affected by risk as defined by equity volatility.
Right. They're affected by the movement of other investments, essentially.
Right.
Like equity investments. Yeah.
So,
but you can invest in them and they move, and you obviously can successfully increase your value based on their movement.
Correct.
Since I chose those investment strategies that tend to do well when equity markets volatility is high.
Right. So it actually is sort of it's a safety zone in a portfolio when the equity markets and other investments may be struggling or bouncing around.
Right.
Yes. As Masao has coined it, it's a self-funding hedge.
It's a self-funding hedge. Okay. And then, as we've talked about, it has no correlation to anything else in your portfolio, but it also it seems to perform well when other areas of your portfolio may not be, that they have a lot of volatility happening. These may still perform as normal, meaning good.
Yes, it does tend to perform better when the equities are tending to perform worse.
Right. Right. Very interesting. We've talked about and I've heard that you may not be deploying all of someone's cash investment into Fuji. So if someone's, putting in 100% of whatever cash they're putting into it, you're making sure that you invest only what the risk profile of Fuji can give statistically what is predicted to be a proper anticipated return without too high a drawdown. But the rest of the cash you're protecting in some way. Is that right?
Yes. Unlike most investments where risk management is an afterthought, it is our primary focus. So we start with risk management and work backwards to maximizing the returns. We only employ as much cash as necessary in Masao's strategy, the DFP strategy, which allows leeway with the remaining cash to allocate to investments that further reduce risk and enhance returns.
So that's something investors can look into, is that how you're using a lot of hedge funds will just let cash sit idle if there's nothing they can do with it. You guys have some plans to make sure it doesn't sit entirely idle and it can still
Right. We think we
perform.
can do better than T-bills for the investors. Both Masao and I have long histories of doing asset allocation.
Understood.
My dynamic factor portfolio tend to be inversely correlated to many other asset classes or investment strategies. So we will naturally combine it with the one that has a negative correlation to DFP.
So let me ask you though, so then if the market is doing really well, if the equities market is doing really well, it can go through many months of boom. Would this not perform as well during those times? Or
remember, I predict future equity volatility, next month's equity volatility. So typically in those months, I do not predict high equity volatility. Markets tend to do well. In that case, my DFP strategy is not engaged.
So yes, I mean, our better months are when it's engaged, but it's only engaged about 50% of the time.
What's my next question? How often is it engaged versus not? Okay.
Right. So, as the old saying goes, timing is everything. And this is really what it's about, is building a portfolio, a very specifically designed portfolio during the period that it's employed, and picking the periods where it is employed.
Right, which is what most investors are looking for. We can make good choices, and particularly if we make choices when the rest of their investments aren't doing so well, everybody's looking for a good option there.
Right.
So it's been great talking with you all today. At Carl, we've been enabling digital investment and making sure new investors can get access to these kinds of, this is one of our most net new types of investments. How do you guys think, digital investing and having this kind of access is changing the investment landscape overall? What have you seen in the past few years?
I've been amazed how successful it's been going directly to investors and allowing investors to find different investment opportunities. Years ago, you had to buy a book that listed hedge funds, and spend a couple of $1,000s to get that book. Now you can go online and find, all sorts of investments. Certainly this one is at the forefront of investing, I would argue. And, here you are looking at it.
Yeah, it's kind of crazy. What do you think about there's kind of two views. We're getting to accredited investors who are more like me. I'm a little more of a normal accredited investor, as opposed to institutional investors or accredited investors with multi millions of dollars to invest. What advice would you give a more normal accredited investor when looking at a fund like this and trying to understand what's happening and how do I make good choices about my investments?
Yeah, I'd say investing in Fuji is really like basically doing a similar thing to what some of the sophisticated institutional investors do. And it's a good way of having a return stream that result from the new style of asset allocation called TPA. And it's a good way for accredited investors or individual investors to grow their asset in the long run.
Right. My thought, Jamie, is that often individual investors chase recent performance. Like you said, the stock market's going up and people chase that performance. Our design is to offer a long-term wealth building opportunity for our investors. This is something where we expect investors to stay with us for a very long time, and we hope to perform well for them over the long haul as well as the short haul.
All right, sounds good. I'm sure our investors will take a look at Fuji and look at how the strategy that Fuji is based on has performed. It sounds like you guys have you're pioneering new investments to new investors in a way that has never been seen before. It's very exciting. I congratulate you both. I'm very interested to see what happens here, and I wish you all the best as you continue to talk about this investment. And I hope to have you on again, because I think listeners may really want to hear more about this as you guys grow and you learn and you talk to more investors. Any final thoughts or anything else you'd like our investors to know before we say goodbye?
Well, there's one thing I'd like to mention is that I'd like investors to know that there have been 3 periods of 20 years in the last 100 years where Treasury bills outperformed stocks, and the stock market bottomed in 2009. So we're inversely correlated to the stock market, and I think it might be a very good time to diversify if you haven't.
I think everybody's
Yes.
always looking for that diversification option.
Yeah.
Yes, Masao.
Support what George was saying. If you remember at the beginning, I talked about this 7-year period of U.S. equity returns. I also compared to the U.S. government bond returns. So in those months with high equity volatility, on average, basically U.S. bond outperformed equity substantially.
Sounds good. Gentlemen, thank you so much for joining us today. Investors, go ahead and take a look at Fuji. We're excited to have this new opportunity on board. Thank you for joining us and for another episode of Invest with Carl. Bye-bye now. See you next time.
Thanks, Jane.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.